a currency at war with itself. It began as a quiet confusion that crept through markets and main streets alike. Two forms of money circulated side by side, each claiming legitimacy, each shaping daily life in different ways. And beneath that surface conflict lay a deeper battle over who truly held the power to define America's financial future. To understand why this struggle still resonates today, we need to return to an era marked by expansion, uncertainty, and competing visions of prosperity. The nation was growing faster than its monetary system could adapt. States issued their own banknotes. Private institutions printed bills of varying quality. And the federal government, still shaping its identity, struggled to impose a standard. The result was a landscape where money itself could not be trusted without scrutiny. This confusion created a strange dual world. In one pocket, a merchant might carry notes valued at full worth. In another, bills accepted only with hesitation. Travelers crossed state lines unsure whether their savings would retain value on the other side. Entire communities built their livelihoods on currencies that outsiders considered unreliable. Confidence became a regional language, spoken differently across every border. The tension grew more complex as states fought to defend their banking rights. Each institution believed its notes were vital to local commerce. But as trade expanded, inconsistencies caused friction. Some regions thrived, others stagnated. And with each disagreement over value, acceptance, or redemption, the divide deepened. Yet the early beats of the story reveal something even more significant. The currency conflict was not merely about money. It was about identity, sovereignty, and the struggle to create unity in a nation built on independence. Every dispute over notes hinted at the larger question looming ahead. Could America truly function as one economic body, or would its fragmented currencies pull it apart? These first fractures were only the beginning. The battle over control, trust, and financial coherence was about to intensify, forcing the country to reckon with the cost of a currency torn between competing visions. As commerce expanded, the cracks in the nation's currency system became harder to ignore. Every transaction carried a question mark, every banknote a silent negotiation. Merchants inspected bills against worn pamphlets that listed distant banks and the fluctuating value of their notes. A piece of paper worth $1 in one town might be accepted for only a fraction in the next. The instability slowed trade, strained relationships, and eroded the confidence that thriving markets depended on. Banks tried to defend their notes with promises of redemption, but those promises were only as strong as the institution behind them. When rumors surfaced about a bank's solvency, its notes plummeted in value overnight. Travelers felt the sting most acutely. They arrived in unfamiliar towns only to learn that their carefully saved funds were treated as little more than curiosities from a far-off region. Anger simmered, distrust deepened, and the sense of belonging to a unified nation felt increasingly fragile. Political leaders watched the turmoil with growing concern. Some argued that local autonomy should remain untouched, that the freedom to issue currency was essential to preserving states' rights. Others pointed to the chaos and insisted that the nation could not function with dozens of competing monetary standards. These debates spilled into newspapers, gathering passionate supporters on both sides. The argument was no longer about simple economics. It had become a philosophical struggle over the meaning of unity. Meanwhile, private actors stepped into the void. Exchange brokers emerged in busy intersections, offering to convert one type of note into another for a fee. Their services kept commerce moving, but at a cost that burdened ordinary citizens. The very existence of these brokers signaled a deeper truth. The system was operating on improvisation rather than stability. Every workaround revealed another structural weakness. Tensions sharpened further as economic cycles shifted. When credit tightened, weak banks struggled to redeem their notes, sparking localized panics. These shocks spread quickly, exposing the dangerous link between currency inconsistency and financial vulnerability. Communities that relied on seemingly strong institutions suddenly found themselves with worthless paper. Each collapse fueled calls for reform, intensifying the divide between those demanding federal intervention and those resisting it fiercely. By now, it was clear that the currency war was no longer a background frustration. It was a central conflict shaping daily life across the country. The system, flexible by design, had grown too complicated to sustain itself. And every new strain pushed the nation closer to acknowledging a reality many had long resisted. A fragmented monetary landscape could not support an expanding republic indefinitely. Pressure was building, voices grew sharper, and the fight over whose vision of money would define America was about to escalate into a confrontation capable of reshaping the nation's financial destiny. The confrontation intensified as the cracks in the monetary system widened into undeniable fault lines. What had once been an inconvenience became a daily threat to livelihoods. Entire regions found themselves trapped behind currency barriers, unable to trade freely with neighbors. The simple act of buying goods or securing credit now required navigating a maze of valuations, redemptions, and risks that ordinary citizens were never meant to carry. Merchants, once the lifeblood of growing towns, struggled to keep their doors open. They accepted notes reluctantly, aware that their value might collapse before the end of the week. Farmers faced an even harsher reality. They brought harvest to market only to receive payment in banknotes worth fractions of what they expected. Some walked away from deals entirely, preferring to store their goods rather than accept currency that felt more like speculation than promise. The friction was suffocating the very growth the nation celebrated. Inside state legislatures, tempers flared. Lawmakers accused neighboring states of undermining their economies with irresponsible banking practices. Attempts at cooperation dissolved into blame. Some regions passed laws restricting the circulation of out-of-state notes, hoping to protect themselves. But these restrictions only deepened the divide, turning the currency dispute into a political standoff. The idea of a unified national market, once a hopeful vision, seemed to slip further out of reach with every legislative argument. Banks, sensing the shifting winds, took defensive positions. They tightened redemption policies. They demanded collateral where none had been required before. And when rumors surfaced about instability, they watched their notes collapse in value faster than they could respond. The system had become a theater of fear, where even a suggestion of weakness could trigger a cascade of withdrawal and collapse. Each failure fed the next, reinforcing the public's belief that no note could be trusted and no institution was beyond doubt. In major cities, financial centers felt the strain ripple through their networks. Brokers raised conversion fees. Loan terms grew harsher. Investment slowed to a cautious crawl. The uncertainty spread like a pulse through the economy, touching every industry, from manufacturing lines to rural mills, reminding the nation that currency was not merely a tool, but the backbone that held its ambitions together. As tensions mounted, a new question rose to the forefront. How long could a growing republic withstand the chaos of competing currencies? The nation had endured wars, political fractures, and expanding frontiers, but the instability of its own money now posed a threat from within. The conflict demanded resolution, yet every potential solution carried consequences that reached far beyond economics. The struggle was no longer about paper. It was about power, trust, and the identity of a nation still defining what it meant to move forward together. The country now approached the breaking point of its long simmering crisis, a moment when hesitation would no longer be possible, and a vision that triumph would shape the future of American finance for generations. The breaking point arrived when a series of bank failures exposed just how deeply the fractured currency system had weakened the nation. Notes that had once passed hand to hand with tentative confidence now collapsed in value overnight. Merchants refused them. Travelers discarded them. Families who had trusted their savings to local institutions found themselves holding paper that no longer meant anything. The crisis revealed a truth that had lingered beneath the surface for years. A nation cannot move forward when its money pulls it in different directions. As the panic spread, leaders who had once defended the autonomy of local currencies confronted a harsh reality. The system was not just inefficient, it was dangerous. It left communities vulnerable to distant failures. It trapped industries behind invisible borders. It forced citizens to question the worth of every transaction, every paycheck, every promise. In the chaos, even the staunchest opponents of federal oversight began to acknowledge that unity required more than shared ideals. It required shared currency. Debates ignited across the country with new urgency. Should the federal government step in and impose a single standard? Should states surrender their long-held authority over their own banking systems? The arguments turned emotional, fueled by the pain of lost savings and shuttered businesses. Yet beneath the tension, a quiet consensus began to form. The cost of fragmentation had grown too high. The Republic needed a foundation strong enough to support its expanding ambitions. The shift did not happen overnight. Proposals circulated. Committees convened. Critics warned of dangers in centralization. But the memory of instability was fresh and unforgiving, and the demand for reform grew louder with each passing month. Gradually, the nation moved toward a new monetary order, one designed to bring coherence where there had been confusion, and stability where fear had once dictated the value of money. Looking back, the currency war stands as a testament to the struggle between independence and unity. It reveals how even well-intentioned systems can fracture under their own complexity, and how a nation's identity is shaped not only by its ideals but by the tools it uses to build its future. The resolution of this conflict marked the moment America began to understand that a shared destiny demanded shared standards, and that the strength of a republic lies in the trust its citizens place in the very currency they hold. Subscribe to join the journey.